Welcome to the Deep Dive. We've got the full breakdown for you today, prepared remarks, the financials, all the Q&A from the Q3 fiscal year 2026 earnings call for Cognyte Software. That's ticker CGNT.
Yep, and this is a really interesting one. They're a US-listed company that's deep in AI-powered investigative tech.
And this call covers the quarter that ended back on October 31st. The numbers dropped pre-market on December 9th, and, well, the market reaction was immediate. It was strong.
Oh, absolutely. A big rally on the day.
So our mission today is to get into the weeds, figure out why the market got so excited, and really see if the story holds up under the microscope.
Let's do it.
Okay, so let's just start with the headline numbers. This was what you'd call a classic clean beat and raise.
It really was. No asterisks, no excuses, just a solid report.
On the top line, revenue came in at $100.7 million. That's up about 13.2% year over year.
And it also nudged past what the analysts were expecting.
Right. But the real showstopper, the thing that, really turned heads, was the profitability. Non-GAAP EPS landed at 3 cents.
Which doesn't sound like a lot, but you have to look at the consensus.
Exactly. The analysts were only looking for a penny, so they basically tripled it.
A huge beat on the bottom line.
And that performance, especially the earnings beat, sent a really clear signal. The stock closed the day up over 10%.
And it wasn't on light volume either. This was a conviction move. Trading volume was up, almost 9% above its average?
So the big question is, what was the engine behind that incredible profitability beat? How did they do it?
It's a fantastic question, and the answer is, it's really the core financial story of the quarter. It wasn't just about growth, it was about operational leverage.
Okay, break that down for us. What does that mean in plain English?
So for you listening, operational leverage just means that your profit grows way, way faster than your revenue. The business is getting structurally more efficient.
It's squeezing more profit out of every dollar of sales?
Precisely.
Yeah.
And if you look at the actual numbers here, it's pretty telling. For roughly every $12 million in new revenue they brought in compared to last year, they managed to convert about $5.3 million of that directly into incremental adjusted EBITDA.
Wow. That is a powerful conversion rate.
It's exactly what analysts want to see. It proves costs are under control while the high margin revenue is just taking off.
So how did that translate into the actual EBITDA figures for the quarter?
It translated into adjusted EBITDA hitting $11.9 million. That's an 11.8% margin for the quarter.
And to put that leverage in context.
That number represents an 81%. Let me say that again, an 81% year-over-year increase in EBITDA. The margin itself expanded by around 440 basis points.
And just a quick reminder for everyone, a basis point is 100%. So a 440 basis point jump means their profit margin grew by 4.4 percentage points in a single year.
Yeah, that's a serious inflection point in their financial story.
So this is quality stuff.
Oh, absolutely. And you see that value reinforced in their gross margin. Non-GAAP gross margin hit 73.1%. That's up almost 300 basis points from last year.
And management was pretty clear on why.
They were. They said this shows that customers who are mostly, governments and intelligence agencies, they are willing to pay a premium for this tech because it's mission critical.
Okay, so a fantastic margin story. But was it just about them tightening their belts? Or was there a shift in what they were selling?
It was overwhelmingly the shift in the revenue mix. They have a strategy, and they're executing it perfectly. They're moving away from that lower margin professional services work.
Right.
And going all in on high margin software.
And that software number was the driver.
It was the undisputed driver. Software revenue, so think licenses, subscriptions, all that good stuff. It grew a massive 39.6% year over year, came in at $41.9 million.
So the high margin part of the business is growing the fastest.
Exactly. And when you look at the total picture, high margin software sales with the related services make up over 88% of their total revenue now. They're actively pruning the less profitable contracts.
And that pruning shows real discipline. I mean, they actually let their professional services revenue drop by about $1.7 million. That's not an accident.
Not at all. It's a strategic choice. They're prioritizing margins over just, raw top-line growth.
And what's the end goal for that segment?
They're aiming for professional services to eventually settle at only about 13% of their total annual revenue. So big shift. And that financial discipline, It flows right through the income statement and onto the balance sheet.
Which is critical. So how's the cash situation looking?
It's looking very strong. Operating cash flow doubled year over year to $25 million. That gave them $23.2 million in free cash flow.
And the balance sheet itself?
Rock solid. They ended the quarter with over $106 million in cash and this is the important part, zero debt.
A clean balance sheet like that gives you options. And it looks like they're starting to return some of that cash to shareholders.
They are, yeah. It's a measured step. But they bought back about 152,000 shares for $1.3 million. It's a signal of confidence from management in the company's value.
Okay, so that's the financials. Let's pivot to the strategy. Where does this future profit actually come from? They're leaning so heavily into AI.
They are. The CEO basically said the core demand right now is for AI-powered investigative and decision intelligence solutions.
And the big product news was this new GenAI Copilot.
That was the most interesting reveal, for sure. This isn't just a buzzword for them. It's designed to fundamentally change how an intelligence analyst does their job.
So instead of manually digging through data.
Right. Instead of sifting through these mountains of disconnected data, the Copilot uses generative AI to synthesize it, to summarize it, and to prioritize threats. It's like an automated investigator.
And that's a real differentiator.
It is, and they're getting industry recognition for it. Gartner's given them props for their predictive analytics. It really backs up their claim that they are an AI-native platform.
And this seems to be attracting some really sticky, high-value customers. What were some of the key wins you saw this quarter?
We saw a few big ones that really show the quality of the business. They locked in a $5 million follow-on subscription with a Tier 1 military intelligence group in EME.
So an existing top-tier customer is doubling down.
Exactly. And then they renewed and expanded a deal with a long-standing national intelligence customer. That's a deal with an annual support piece that's worth more than $20 million a year.
So it's not just new sales, it's proving the solution is so ingrained that these customers just can't leave.
It's incredibly durable business.
Now, to really understand why these agencies are paying a 73% gross margin for this tech, you have to get into the real-world problems they're solving.
You do. And management summed it up perfectly. They said the threat is unified, the data is not.
And that's the whole value proposition.
That is the whole value prop. They're solving this massive data fragmentation problem. They gave two really striking examples. The first one was about transnational crime. So imagine you have all these data silos.
Right.
One agency is tracking opioid routes, another is looking at violent crime reports, a third is monitoring weird crypto flows.
All separate units looking at what they think are separate problems.
Precisely. But the Cognyte platform pulls all of that together. It correlates the communication data, the financial transactions, the travel patterns, and suddenly it reveals all these things are being run by the exact same criminal network.
That's a massive leap in efficiency for investigators.
Huge. And the second example was on hybrid activity, the state-backed stuff. You might see a bunch of things that look totally unrelated.
Like what?
Like a spike in online disinformation, protests that turn violent in a few cities, and then suddenly a big hospital system gets hit with ransomware.
Okay, how on earth do you connect those dots?
Well, their platform fuses it all. It correlates the cyber indicators from the ransomware, the money flows that funded the online campaign, and the travel patterns of known actors. And it shows this is all one coordinated campaign backed by one specific state actor.
That is why they can charge a premium.
That's a secret sauce.
Okay, let's turn to the U.S. market. Management keeps flagging it as a huge growth opportunity. How are they doing there?
The underlying need in the U.S. is exactly the same, but the market is... well, it's more complex. They're really focusing on state and local agencies, plus the federal sector.
And they're clearly trying to get better market access, which is always tough in the U.S. federal space.
They are. The new partnership with LexisNexis Solutions is a really big deal for that. LexisNexis has a massive footprint in government agencies already.
So they're leveraging that sales force.
Exactly. Management said they've already trained up the LexisNexis sales team, so that channel is actively being turned on right now.
But not all smooth sailing. They did mention some headwinds.
Right, they did. There was a temporary disruption in the U.S. federal business because of the government shutdown and all the budget delays. It messed with contract timing.
But they're still bullish long term.
Very. They said federal customers started re-engaging the second the budget mess was sorted out. But it's important for you to remember the U.S. is a tough market. They're going up against big established players like L3Harris and Octac.
That makes sense. And that brings us to the forward guidance. We know the market liked the beat, But the raised guidance is what really sealed the deal.
The raised outlook was the real catalyst. For the full fiscal year 2026, they bumped their revenue target up to around $400 million.
But crucially, they lifted the profit targets even more.
Way more. Adjusted EBITDA was raised to about $47 million. That's signaling something like 60% year-over-year growth. And non-GAAP EPS got lifted to about 24 cents.
That 60% EBITDA growth target for the full year, that's the ultimate proof of that leverage story we were just talking about.
It is, and they have the visibility to back it up. Their total remaining performance obligations, or RPO, that's all their contracted future revenue, is at $576 million.
That's a healthy backlog.
It is. And even the short-term RPO, so revenue they expect in the next 12 months, is at a very solid $359 million. They know where most of next year's money is coming from.
And if you put this into market context, CGNT has crushed both the S&P 500 and the software ETF this year, especially after this report. This isn't just them riding a market wave.
No, this is them executing a really successful turnaround. And they think it's sustainable. They came out and reaffirmed their big fiscal year 2028 targets.
Which were?
$500 million in revenue, and this is the key part, an adjusted EBITDA margin of over 20%. They're telling the market this isn't a one-off quarter.
Okay, but for the sake of balance, there has to be a lingering concern. What are the skeptics pointing to?
The main point of skepticism is the difference between these great adjusted results and their official statutory results. The company still posted a negative GAAP net loss of $3.4 million in Q3.
Right. The non-GAAP numbers look fantastic, but the official GAAP number is still in the red. Why does that disconnect matter so much if the operations are strong?
Well, the GAAP number is the one that includes everything, especially non-cash expenses like stock-based compensation. So while adjusted EBITDA shows you the health of the core operation, that persistent GAAP loss makes some analysts question the long-term impact of those excluded costs.
So it's the final piece of the puzzle they're waiting for.
It's the key metric they'll be watching to see if the profitability turn is truly complete. And of course, you can't ignore the geopolitical risk that comes with a customer base that's so heavy in defense and intelligence.
Okay, and that brings us to our segment. This is not financial advice. We are here to break down the information, not to tell you how to trade it. But if you had to pitch an outrageous but plausible trade idea based just on this story, what's the setup?
The setup is pretty clear. The market is rewarding two things: that exceptional operational leverage and the GenAI story. The long-term plan looks good, but the stock is volatile. It's sensitive to short-term news like U.S. budget fights.
So you'd want a trade that captures that long-term story, but maybe sidesteps some of the short-term noise.
Exactly.
All right, the pitch is a leveraged outperformance bet. Here's how it works. You buy deep in the money, long-dated call options. Think 18 months out, maybe more.
So you're using options leverage to bet on the long-term margin story.
Precisely. You're using that structure to amplify your returns if, and it's a big if, management actually hits that 20% margin target in fiscal 28. It's a long-term bet on their execution.
Okay, that's the long side. How do you hedge it?
You hedge it by simultaneously shorting or buying put options on a relevant peer, maybe a U.S. federal defense player like L3 Harris, one of the companies they mentioned. You pick one that does not have the same clean, high-margin AI software story.
So the trade is basically long CGNT's unique execution and short sector complacency.
You got it. You're betting on their specific turnaround story, no matter what the broader defense sector does.
So to wrap this up, Q3 confirms that Cognyte is pulling off a very difficult transition. They're moving from that lumpy services-heavy model to a high-margin, software-first AI platform.
And the combination of that mid-teens revenue growth with the aggressive margin expansion. It's clearly working. The market loves it.
They are delivering on that promise of structural operational leverage.
So what does this all mean for you? Well, with their strong backlog and clear guidance, the really critical question for the next few quarters is this. Does that new GenAI intelligence co-pilot become an additional driver of revenue? Does it kick things into an even higher gear?
Will it turn this leveraged growth story into an even more powerful, accelerated AI franchise story?
That's the trajectory we'll be watching very closely in 2026.
It should be fascinating.
Thanks for diving in with us. Stay informed, and we'll catch you next time.